Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my partner, Chen Lin, works with me as well. My company, Taylor Hard Money Advisors, is in partnership with Chen, and he produces What is Chen Buying, What is Chen Selling. Two analysts at Goldman Sachs did indeed suggest to their clients that they should short gold, suggesting that in the next 3 months, gold would be heading to $1,100 and then to $1,000 by next year. Those two analysts, Jeffrey Curry and Max Layton, are again urging their clients to go short. They're suggesting that systemic risks from oil, China, and negative rates are very unlikely. And they said banks have ample liquidity to maintain funding against higher capitalization. The negative macro impacts from low oil prices have likely already played out and are not systemic, while the spillovers from China are limited and the U.S. is far from a recession. Well, of course, many of the guests that I've had on this show, many of the guests, if not most of them, are not ready to buy this honky-dory story that the Goldman Sachs guys are telling us. But, of course, it is highly logical. A remark like that from Goldman Sachs. Just realize that the foxes must keep the chickens relaxed so that they can more easily be caught for the fox's next dinner. So that's what I think might be going on with Goldman Sachs. But who knows for sure? I'm really happy to have Michael Oliver with me. Thanks for joining me again, Michael.
Oh, I'm always glad to be back.
Hey, what do you think? The fox is looking for an easy catch for dinner? What's going on here? Goldman Sachs is looking for $1,100?
Yeah. I'm going to be John Kasich on this and not say anything bad about the other folks, in this case the analysts. All I can say is that MSA's work, Momentum Structural Analysis' work, had a clear-cut basing pattern for gold based on annual and quarterly momentum for quite a while, and that broke out several weeks ago as gold emerged up through the 1140s up to 1169. That was my highest breakout number. Mm-hmm. Within days of that, we reached over 1260. It's now pulled back under 1200 intraday. It's now 1204 last I saw. That pullback is totally within the parameters of being fine and still upside. There's nothing negative in that. What it hit was a price chart feature that I showed in a weekend report last week that showed that there is, in fact, some price chart resistance around 1260. And sure enough, the market responded to that. I think it's a temporary barrier. I think it's the sort of thing that you could call a secondary breakout once gold overcomes that level, and I think it will. Why? Because momentum already has blown that equivalent level totally out to the upside. Mm-hmm. And usually when momentum readings action of the market using monthly bars of gold, price chart bars measured against a 3-year average or a 3-quarter average, when they've broken through a similar structure ahead of price will usually follow suit. So I stand with my view is that gold has bottomed. The pullback here to 1200, even to 1180, wouldn't bother me in the least. And I suspect this, if you find that gold congests below that 1260 level but doesn't fall apart and just flip-flops around for the next several weeks underneath that level, then I think what it's doing is setting up for the price chart folks that 1260 level as a breakout level, at which point when you overcome that, I suspect these Goldman Sachs guys and a lot of people who are short are going to get hurt real fast. My objective after a breakout over that price chart level, again, momentum is what I primarily reference, and it's already positive. But once you break through that 1260 barrier that we peaked on last week, 1450 is my next target.
Wow,
that's a resting point. That's not an end of a bull market. That's the first major leg up. Is what I would call that, the end of the first leg. But I think that if you can get through that 1260 after some due diligence, congestion, backing off, that type of thing, there's a vacuum between that level and 1450. Quite a vacuum. Meanwhile, obviously, during that same time, gold miners will do a lot better. They have done better than gold on the upside, and I continue to think that they're a better place to be in a bull trend in gold than gold itself.
Well, most certainly, with oil remaining low, oil prices and energy prices in general remaining low, and with lots of people unemployed now in the mining sector, there certainly are some lower costs. I'm talking to drillers and people in Quebec and elsewhere. One CEO was telling me yesterday in Quebec he can get his drilling cost at 50% off of where they were a couple of years back. So, yeah, I mean, that looks to bode well. So I have to ask you about how's the oil patch look to you now, Michael? Have we seen a bottom? Or we're about to? We're hearing talks today about Russia and Saudi Arabia coming together, perhaps not the best of friends to be sure, but maybe looking after their own interest, they might make an agreement to try to hold some oil off the market. So we looked at the fundamentals, but what are the technicals telling you about oil?
Well, I can get bullish on oil, but I can't get bullish on it here at all. I think the bullish situation for oil is going to present itself probably in the second quarter. But I'm not at all sure we've seen the low prior to that bullish turn. And I also hold the view, and this is not really scientific, it's more of a gut feel. I've had it for a while, that you're not going to bottom oil until you've busted the S&P to its first major low. Okay. And we have not done that, in my view. I think that first major low in gold, the S&P is going to be well below this low 1800 nonsense, which buyers continue to bid in front of and bid in front of and bid in front of. It's like a line in the sand that you could draw with a crayon. And I think that when that goes and the whoosh that follows on the S&P to the downside, at around the time the S&P makes its panic low, let's call it in the 1600s, which is my first working target, I suspect at that point oil will make its final low. Whether that's a dollar below the recent lows or something like that doesn't matter, but I don't think oil is going to give stocks a relief rally that sustains them.
All right, so there's no hurry to get into oil then, but as a person who follows mining shares, it doesn't bother me at all that the oil price remains low.
Right.
Energy prices remain low. It should help gold mining profits, I would think. So 1600s is your target. Any sense of the timing on that, Michael?
I think that this. I put out a report last week, actually a two-parter, and the last one was called "The Meeting." There's a big meeting on the 26th and 27th of this month in Shanghai,
yes.
G20. It's an urgent meeting. It has all the earmarks of panic. You can read it in the press, reputable sources, Bloomberg, their financial sources, quoting Japanese BOJ people, European people, that there's a lot of nervousness that they are in the final play. They've got to stop the markets from collapsing that have suddenly gotten out of their control, namely the developed equity markets. Also, a couple of the foreign exchange markets have gotten out of control. The yen has gone up sharply. The euro is beginning to firm. They can't stand that because it means they don't control the events anymore. If they don't control the events, who does? Therefore, there's a sense of panic. Now, what does that mean? It means for the investor asset manager in the U.S., who is a believer in the CBs, hope is coming because of the big meeting.
Yeah.
The question is whether, one, the market will hold together until then, or will it panic first to force the CBs into some kind of drastic action at the end of this month, or will it sit here and wait for milk and cookies to be distributed by the CBs after that meeting occurs and be disappointed by the milk and cookies? I don't know the answer to that. That's a short-term issue, and my short-term indicators can go either way right now. And I'm frankly a little bit confused, therefore I won't make a forecast on that. I will forecast, though, that the S&P is topped. It's a bear market now. It's going a lot lower, likely into at least 2017.
Wow. Any ultimate downside target, Michael, or is it too early to say?
I don't have. I think that there will be a severe test and probably a breakage back below the all-too obvious two peaks of 2000 and 2007, both of which peaked at 1550, and the other one peaked at 1570. So there's an obvious price chart level there in the mid-1500s that no doubt most price chartists will view as support. I think before you bottom, you will probably blow that level out sufficiently to where those folks are disappointed.
Oh, my goodness.
Gently pull back to a level that's so obvious as that.
Yeah. So you think we could see the lows?
I can't go crazy. I can't. Okay.
So you're not willing to say that we'll take out the lows of 2008, 2009.
I've got some. I did a report a few weeks ago dealing with that issue, and I forecast it out till 2017, and I'll give you the number now. I used the Dow Industrial since it could go back to the 1900s.
Okay.
If in 2017 you see the Dow at 11,700 area. That's what's well below us. That would be equivalent, I think, to the S&P being down in the high 1300s. If you see that, you're jeopardizing about an 80-year-old uptrend line on 10-year average momentum. And that's a mouthful. What I'm saying is there is a momentum support structure that comes through around that area, but it's been used and used and used. Therefore, it looks vulnerable. So if the bear market, for any reason, by 2017 can dig down back below the Bin Laden high in the S&P, and that was the May of 2011 when it hit 1370 and then dropped. If you drop much below that level in the year 2017, there are big problems.
Okay.
I can't forecast that will happen. I'm just defining the number.